today and I had $10,000 to invest, I'd start with the A's. I would start going right through companies, and I probably would focus on smaller companies because I would be working with smaller sums and there's more chance that something is overlooked.
That there is legendary investor Warren Buffett, CEO of Berkshire Hathaway and arguably known as one of the world's greatest investors. Since taking over the ownership of Berkshire Hathaway in 1964, Berkshire Hathaway has far surpassed the S&P 500 for well over 50 years. If you have a look at Berkshire's current 13F filings as they stand today, you will notice he holds a lot of large cap companies. Given that clip we've just watched, you might be surprised to see that. So why is that? Why is Warren Buffett holding all these large cap companies, and why is he not redistributing this money into small businesses? Well, we'll let Warren Buffett explain why.
Well, the answer to that is that we don't look anymore. We assume that there are a reasonable number of opportunities as you work with smaller amounts of capital, because it's always been true.
Although Warren Buffett loves investing into these smaller companies, due to the time it would take to research all these companies, learn about the business, analyze the financials, and learn a little bit more about the management, it would not be worth it for him to invest into this company. Let's say for the Cheesecake Factory, for example, which has about a $1.74 billion market cap as it stands today. Given that Warren Buffett's Berkshire Hathaway is at a near size of nearly $1 trillion, he could buy the Cheesecake Factory over and over and over again. Unfortunately, there is only one Cheesecake Factory in the world, so even if Berkshire Hathaway was to make 100% return on the Cheesecake Factory, and he bought the entirety of the Cheesecake Factory at that $1.74 billion range, do you think a $1.74 billion profit would even make a dent in their portfolio? Well, no, not really. So this is the issue that Warren Buffett keeps coming with when it comes to investing into these companies. But fortunately, us smaller investors, we don't have this same issue. We can pick businesses that will provide us with the best value, and we do not need to take into account market cap. This explains why Warren Buffett only holds large businesses. We do need to consider that some of his greatest successes were in the early parts of Berkshire Hathaway, specifically during the 60s, 70s, and 80s is when Berkshire Hathaway had their most success, and since then their success rate, although still well above the S&P 500, has been significantly lower in comparison to these early investments that were really successful that you might know about, include Coca-Cola, Geico, and maybe one that's not so heard is See's Candy. So See's Candy was an investment he made really early on in his career, and it's one that has been very successful where he's bought the company, he's let the company compound, grow, and it's turned into this big company, and they've been really successful with that investment. So that investment into Coke, although it was still a pretty big investment, it was worth it based on Coke's size and his portfolio size at the time. If he was to buy Coke now, he could buy Coke 3 times over. Given that information as to why Warren Buffett invests into larger companies and not these small businesses, but he would prefer to invest into these small businesses, let's take a deeper dive as to why this is the case.
Well, I would use the approach that I think I'm using now of trying to search out businesses where I think they're selling at the lowest price relative to the discounted cash they would produce in the future. But if I were working with a small amount of money, the universe would be huge compared to the universe of possible ideas I work with now.
Although large established companies such as Microsoft and Apple have products all over the world and can still easily grow much faster than the S&P 500 if they play their cards right, growth for these large companies is so much harder to come by. Imagine a local grocer. Compared to these tech companies who have products all over the world and have reached global market saturation, this local grocer may only be in one area of the world. It is so much harder to gain more customers if you already have almost all the customers in the world. A local grocer may only have a really small customer base. If they sell great products and everybody within the local area loves the things they sell, there is no reason why they cannot grow within the city, and then from there grow into other parts of the country, and then from there grow into other parts of the world. Because of this, small businesses don't need to worry about what their next expansion opportunity is. For them, it is very simple. Grow into another area of the state, country, or whatever they would like to do. For Apple and Microsoft, they've got to think about developing new products, how they're going to promote it, how they're going to do better than their competitors, how they're going to hire the staff. There are so many other barriers for them to be able to grow. Point number 2 is these smaller companies tend to be mispriced. Let's watch an example from Warren Buffett and see him explain as to why he invested into the Atlet Corp and what this investment was for him and what he paid for the price of it.
One time I bought one share of stock in the Atlet Corp. That's spelled A-T-L-E-D. And Atlet had 98 shares outstanding, and I bought one. And not what you call a liquid security. And Atlet happened to be the word Delta spelled backwards. And 100 guys in St. Louis had each chipped in $50 or $100 or something to form a duck club in Louisiana. And they bought some land down there. 2 guys didn't come up with it. There were 100 of them. 2 of them defaulted on their obligation to come up with $100. So there were 98 shares out. And they went down to Louisiana, and they shot some ducks, but apparently somebody fired a few shots into the ground, and oil spurted out, and those Delta Duck Club shares, and I think the Delta Duck Club field is still producing. I bought stock in it 40 years ago for $29,200 a share, and it had that amount in cash, and it was producing a lot, and they sold it. If they kept it, that stock might have been worth $2 or $3 million a share, but they sold out to another oil company.
So as shown in that clip there, Warren Buffett received an incredible deal to buy a piece of the business. He paid $29,000 and received $20,000 in cash and $11,000 of royalty income at $3 oil and 25 cents of gas. Fortunately for Warren Buffett, this opportunity was presented for him. Although in saying that, do you think this opportunity would have been in the New York Times or in any other major news outlet? No, it wouldn't have been. This was only a really small business, and it wasn't even a business as that. It was a duck hunting club. So he was very fortunate to receive this opportunity, but because Warren Buffett noticed the deal, he saw the opportunity that was available to him, and he took it. This also ties back into Warren Buffett's current problem. Berkshire Hathaway has become so big and they have such a large market cap. Do you think investing $29,000 into this business would be worth it for him and Berkshire Hathaway? No, it wouldn't. If this $29,000 investment turned into $2 million, it would still not make a dent in Berkshire Hathaway's portfolio size, and it would really not do much for their market cap and their share gain percentage. Because of that, Warren Buffett would still need to do all this research and take all this time to analyze the financials and do all the proper due diligence to make sure this opportunity was a worthy opportunity. It just would not be worth it. And what he would do in this scenario was he would just throw it away, because he would recognize what this business actually was, and he would realize that realistically, almost at a certain point, no matter what the gains was, it would just not be worth it for him. Another reason why we want to be investing into these small businesses is because they typically receive less media attention than these large businesses.
We assume that there are a reasonable number of opportunities as you work with smaller amounts of capital, because it's always been true. I mean, it was over the years, as I looked at things, clearly you run into companies that are less followed as you get smaller, and there's more chances for inefficiency when you're dealing with something where you can buy $100,000 worth of it in a month rather than 100 million.
Large businesses are constantly in the news and are always broadcasted on CNN or CNBC or any other major news outlet. As a result, there are a lot of eyeballs on these companies, and because there is only so much limited information that gets given out in the news outlets, people only invest in what they know, so to speak. This doesn't necessarily mean they know the operations of the company. They just know this business exists. And because of that, a lot of people tend to gravitate towards these really big companies. Because there are so many eyeballs on these large companies, small companies tend to fly under the radar a fair bit. Large retail investors and hedge fund managers typically do not see these smaller businesses. Fund managers aren't even necessarily always allowed to invest into these small businesses due to regulation purposes and risk management purposes within their own businesses that they operate in. Although larger businesses tend to be more stable because they have proven growth and they have proven they can continue to be successful for decades on end and sometimes even centuries, this means a lot of people feel safer investing into these large businesses. Just because small businesses tend to be a little bit more risky, this does not mean they can still become successful and grow into a behemoth like some of these larger businesses such as Apple and Microsoft now. Although yes, it is incredibly hard to grow a business to $1 billion business, and it is incredibly likely these businesses will never catch up with Apple, Microsoft, or even the Cheesecake Factory, in all honesty. But they can certainly grow much faster than these businesses, such as those large corporations. And this is where your research and your due diligence and have done everything you need to make sure you feel confident that this small business will continue to grow at a rapid rate and will also be a fair price for what you pay for it. So how do we use this information to our advantage? How do we use what Warren Buffett has taught us as a way to approach this strategy, and how can we improve our portfolio and improve our investment returns? What I like to do is I like to use Seeking Alpha. Seeking Alpha is a community investment platform which allows you to do a number of various things. You can have a look at the financials of a company. You can read analyst reports. You can also comment on the analyst reports. And you can also use a stock screener, which is what I love doing and which is how I find these small businesses which I think are a worthy investment. Using a stock screener will allow us to do a various number of things. We can filter for companies which are growing really fast. We can filter smaller cap companies. We can even filter companies who have consistently grown their dividend for a number of years. I'm not going to advise on any specific approach because ultimately it is up to you what you do with your investment, and I'm not here to provide any financial advice, but using Seeking Alpha will certainly speed up your process into analyzing these companies and analyzing the businesses that you may want to buy. If you are interested in using Seeking Alpha, I have an affiliate link in the description down below. They will be able to give you a discount for your first year. Until then, I hope you learned something in this video, and I hope this information has been helpful for you for your investment journey.